The biggest opportunity in real estate since 2008, but it's not deja vu. In 2008, the real estate market didn't stumble, it collapsed. Lehman went under, banks froze, lending overnight, people were mailing their keys back to lenders, and the stock market was an absolute free fall. Now, back then, the crisis was residential and it was liquidity based. People that had no business buying homes got homes. So everyone was over leveraged, subprime loans, teaser rates, zero doc mortgages, and people had no business owning homes that they were in. And when prices dropped 30 to 50%, they bailed. It was ugly. And that's exactly when I got into the multifamily real estate investing game. I was 23 at the time. I was freshly recruited by a private equity firm. And we were working with Ken McRoy of MC Companies, raising capital to buy multifamily assets across the US. So look, while everyone was running for the doors, we raised over $300 million and bought buildings for pennies on the dollar. So a question I get asked all the time is, what was the biggest lesson that I learned as a 23-year-old stepping into that kind of market chaos? Well, yeah, I was young. I probably had no business being in that room, to be totally honest. First of all, everyone was older, more experienced, they dressed better. Heck, they even talked in acronyms I didn't even understand at the time. But the lesson hit me fast. Money doesn't disappear. It just looks for leadership. And when things collapsed, most people freeze. They get paralyzed. Very few people have the ability to stay calm, but the ones that do, they're the ones that are able to attract capital like a magnet. I remember this one guy, for example, he ran a manufacturing business. And when I was meeting with him and walking him through how we were doing things, he just said, man, like if you're this calm at 23, you're gonna be dangerous at 40. And that really stuck with me because in the middle of the chaos, I may have not been the smartest, but I did stay steady. I leaned on the math. I leaned on my mentors. And I can tell you right now, capital doesn't want hype. It wants confidence. Good analogy is it's like flying a plane in a thunderstorm. Everyone's freaking out in the back, but if the pilots come, nobody's jumping, nobody's putting on a parachute. And that's what investors want. They want a calm pilot with a plan. Another question I got during that time is, what were you feeling like during that time? I mean, the whole market was on fire. Well, for me, it was a little bit of fear and fire because picture this, I'm literally showing up to meetings in a secondhand suit. I got tailored just good enough to look presentable, and everyone's wearing Rolexes and they got their resume from JP Morgan or Merrill Lynch. And yet I had a unique perspective because I had a front row seat to work with some of the smartest operators in the game. And I could feel that something big was happening, even if I didn't fully grasp it. It was like being handed a surfboard right as the wave is forming, and you don't really ask to have time to ask, "Am I ready?" You just start to paddle, and I was so terrified of looking stupid that I was more terrified of missing the moment. And actually, that's what pushed me to pay attention, ask better questions, and really understand how capital works, how dynamics works. And because of that, we were able to raise a ton of money and do once in a lifetime opportunities at that time. Now, why was it just such a critical skill for me at that age? Well, because I realized that the reason why we were able to buy properties for pennies of the dollar back then was because we had already secured the capital. See, deals were everywhere, but the people that actually got them done were the ones that could raise the capital. And for me, it became abundantly clear that it didn't matter how smart you were. It was as important to be able to convince people to take action on that information. So another thing people ask me is, well, how did you guys manage to convince people to invest back then? Well, first of all, we didn't have to convince anybody. That's not what we were trying to do. That's where a lot of people actually get it wrong. What I did instead is I showed up with clarity while everybody else was panicking. And I'd had a simple line that I'd repeat. We're buying properties below replacement cost, and the numbers work without needing the market to bounce back. And that calmed people down because most investors really don't want upside. They want downside protection first with upside potential. I remember one guy pulled me aside and he was, look, if this thing just holds its value, I'm happy. And that was a huge insight for me because, see, investors aren't betting. They're actually looking for a way to protect their capital. And the smarter the investors, the more sophisticated, the more financially well off they are, they're more interested in return of capital before they see return on capital. Think about it like this. If I offered you a Ferrari for $50,000, I don't need to convince you that it's sexy. I could just show you the car, show you the price tag, the condition, and say, look, you can drive it or you can flip it. Either way, it's a win. Another thing I hear all the time, especially back from 08 or 09, oh, well, that must have been easy. You must have had a network and all these rich people to plug into. Let me tell you something flat out. Very few people are born with a network of accredited investors. I wasn't. When I got into this business, I wasn't rolling with my buddies from the country club. My parents were immigrants, and my network were people just like me. So here's what I did and what you can do too. Here's some tactical ways for you to be able to build your network from scratch. Step one, build a basic lead magnet. Nothing fancy. Just a simple PDF titled Why the Next 18 Months Will Create a Once in a Decade Buying Opportunity, as an example. Lay out your thesis, talk about the opportunities, talk about the problems in the market. Look, you don't actually need to be a guru. You just need to frame what you're learning in a way that adds value to the people that you're trying to connect with. Step two, post consistently on a platform, whether it's LinkedIn, Instagram, Facebook, and literally just talk about what you're doing. Break down deals, share headlines. What do they mean? How did they have an implication for investors? And then step three is just DM people who engage. You're not pitching these people, you're just building a relationship. And it could be as simple as, hey, John, appreciate the like on my post about distressed debt or value add multifamily. Curious, are you looking at real estate investments right now, or are you just learning like I was a few years ago? And literally, that's how you turn strangers into conversations. And eventually, conversations turn into capital. And you don't need 1,000 people. You need 5 or 10 people who trust you and know you and appreciate what you stand for. And right now is actually the perfect time to be doing this because the LPs, the investors are on a standstill, and the GPs aren't quite sure what to do next yet either. So if you just apply that today, so fast forward to 2025, where we're at today, the crisis we're in today is not the same because it's not about subprime mortgages or bad lending. It's about debt maturities. It's about inflation. It's about the interest rates, and it's about general confidence in the marketplace. And I can tell you right now, there is a crisis in confidence in the marketplace today because, well, first of all, let's start with debt maturities and what that actually means for somebody who might even not know what that means, day to day practically. Look, a debt maturity just means your loan is coming due. Now, in commercial real estate, most loans aren't 30-year fixed mortgages. They're 3 years, 5 years, 7-year terms. And that's actually where the pain comes in. So let's say, for example, you bought a property in 2020 with a $10 million loan at 3% interest. That 10 million at 3% is 300,000 a year in interest. Now, fast forward to 2025, and that same loan now is say 7%. So now you're paying $700,000 a year in interest on that loan. That's $400,000 more with nothing else changing. And here's the killer. Your rents, they haven't doubled. Your income hasn't gone up on the property, but your costs just exploded. And most lenders aren't going to refinance that loan unless the deal still cash flows under the new debt, which means that the owners typically have to do what's called a cash in, where they have to write a check to pay down the loan amount. And that check is usually millions of dollars, and most people just can't do it. And when the bank realizes that you're not going to write that check to buy down the debt, they take the property back and sell it, often for a huge discount. And that's what I mean when you hear people saying things like the deals don't pencil anymore. Now, another huge factor in today's market before compared to 2008 is inflation. It's a massive impact on landlords because look, rents go up and property values might go up because of inflation. So it must be a win-win, right? Well, not so fast because real estate inflation is hitting investors from both sides. And here's what I mean. So here's a real world example. You bought a 100-unit building. Your total loan is still $10 million and you have a 3% interest rate, which is $300,000 per year. Now, let's say your units bring in $150,000 a month in rent. So that's $1.8 million a year. Now, your annual expenses for wages, insurance, repairs are, let's say, $900,000. So what you're left with is a net operating income. So you have 1.8 million minus 900,000 leaves you $900,000. Now, out of that $900,000, you pay your mortgage, which is 300,000. So you still have $600,000 left there. Now, under those circumstances, you're doing great. You've got net income, investors are getting paid, but let's add inflation to the mix and say those same expenses that were 900,000 now jumped up to $1.2 million. Dollars. Same building, same rent, same everything. So now your NOI drops to $600,000. Now, add the fact that your mortgage is now coming due and you're not going to get it at 3%. It now has to be 7%. So that $300,000 debt service is now $700,000. So before you were cash flowing, now you're upside down $100,000 per year. And the crazy thing, maybe is you ran the property right. Maybe you've done everything well. You're not mismanaging anything, but you're just getting squeezed by inflation and interest rates. So this is the silent killer most people don't see because A, your revenue's stuck, your costs explode, your profits get wiped out. And the thing that determines your property value, NOI, actually shrinks. And if your NOI drops and your cap rate expands, well, your valuation can tank 20 to 30% plus overnight. So here's what I'm seeing in the trenches. Trillions in commercial loans are coming due. There's over $950 billion in commercial loans coming due in 2025, and there's even more in 2026. Office, multifamily, industrial, retail. There's no sector is immune. And this debt wall is what everyone keeps whispering about, but very few people are actually ready for it. Another thing is interest rates. They've doubled or tripled in some sectors. And because of that, cap rates have expanded. And in plain English, what a cap rate is it means your assets, if cap rates expand, it means your assets are worth less. That's a double whammy because your rents aren't growing and your valuations are coming down. And because of that, refi options are drying up too. Banks are nervous, their income coverage ratios are stickier. And even if your asset's actually performing, lenders are demanding 20 to 30% more equity put money into the deal just to refi, just to stay in the game. Because of that, property prices are down. And look, nobody's really talking about this publicly yet, but deals that used to trade for $20 million are now being sold for $12 to $15 million if they're even moving at all. LPs, investors, are frozen. They're waiting for clarity. They're sitting on billions in dry powder. And you know what? They're not chasing IRR anymore. They're just trying to protect their principal. And here's the thing, even good operators are defaulting, not because they made bad decisions in the moment, but because the math isn't mathing anymore. And it's not because they screwed up. It's because, or the asset failed. It's because the way the world works today has changed. See, they underwrote for one reality and now we're living in another. So a real world example of this exact scenario is this. Say an operator bought a 120 unit apartment building in 2020. Say they paid $16 million for it and say they put down 25%, so $4 million, and they borrowed $12 million at 3% interest. This is actually a very typical arrangement from those days. Now, their debt service roughly would have been about $360,000 a year. The building cash flowed well, NOI was strong, investors were getting the preferred returns. Life was good. Now, fast forward to 2025, and that same property had probably a 5-year loan and it matured and it's time to refinance that loan. So here's the problem. Interest rates aren't 3%, they're now 6, 7, 8%. So that same $12 million loan now costs $840,000 a year in interest. That's almost $500,000 more every year just to carry the debt. And it gets worse because the building's NOI has also shrunk too. Because, well, first of all, insurance rates are, depending on where you're at in the country, they're up 40, 50% since then. Property taxes are definitely up. Repair costs are up. Payroll is more expensive. And the rent growth, yeah, there was a bunch of rent growth there, but it's totally stalled out in the last 24 months. So now the lender looking at the refinance is looking at their new debt service coverage ratio, DSCR test, and says, hey, sorry, listen, you actually don't qualify for 12 million in debt anymore. We'll give you 8. Let's say maybe. Now the operator has two options. Number one, they can come up with $4 million in fresh equity to bridge the gap. So imagine having to go back to your investors 5 years later and say, hey, you know that money you invested 5 years ago? Right. So we need you to write another check. Again, today, most people are not going to be happy with that. Or number two, they can sell the property, likely at a discount, just to get it off their books before the loan comes due. Now, if they can't do either before the time runs out, the deal falls apart. And it's ironically not because the asset failed or the tenants stopped paying, it's just because the math changed faster than they could adjust to the changes. The question to ask here is, why are good operators struggling today? Well, in my opinion, it's because many of them underwrote based on the way the world is today. And the truth is, a lot of these guys had never been through a real estate correction before. They didn't see the signs that the music was slowing down. They just assumed that the party would go on forever. I've seen this firsthand for a different reason back in '08 or 9, but I saw under the worst conditions how conservative underwriting was meant to be. So, if anything, for me, the last 5, 6 years before this correction now, I was like, "Are you guys really doing that? Are you guys underwriting?" Like, to me, it was inconceivable. See, because I know that good operators are good at managing what's in front of them today. But I can tell you that the great operators are the ones that know how to plan for tomorrow. So let me give you an example of the biggest issue that a lot of guys ran into this debt maturity wall and why so many of these properties are going to get taken back. It comes back to the concept of cap rate expansion and cap rate contraction. Now, plain English, what does that mean? Well, as a seller, you want the cap rates to contract because it means your assets are worth more money. As a buyer, you want to find times when the market has a cap rate expansion cycle because what that means is the value of those same incomes have now dropped. So, a good way to think about it is, let's assume you have a property that makes $1 million NOI per year. And let's say the cap rate is 5%. So you'd value the property like this: $1 million divided by 0.05 equals 20 million. So that's your baseline. So again, at a 5% cap rate at 1 million NOI, it's a $20 million asset. So when you have cap rate compression, let's assume that that cap rate now goes to 4%. So your math would be $1 million divided by 0.04 equals $25 million. So what's crazy is nothing's changed with the building. It still makes $1 million a year, but because the cap rate has compressed, investors are effectively willing to accept a lower return. They're willing to accept a 4% return. Therefore, the value of that income increases. That's why when people say compression appreciates the property, that's what they mean. And for context, this is what we saw between 2012 and basically 2021. Cheap money, bidding wars, tons of liquidity, which means there was tons of people willing to throw money into the marketplace. And because of that, cap rates got pushed down to the threes and low fours in some markets. Now, let's look at the opposite of that, which is called cap rate expansion. And that's where we are right now. So, take, for example, that same $1 million of NOI, but now make the cap rate a 6% cap. So, it means that the market now expects a 6% return for the same income. So, the math would be 1 million divided by 0.06 equals $16.67 million. So that's a $3.3 million drop in value from the 5 cap baseline. So now let's apply this to real life and what's actually going on. The market's moved more than 1%. In many areas, it's moved 2% plus. So let's assume it went from 4% to a 6% cap rate expansion. So again, 1 million divided by 0.04% is 25 million. 1 million divided by 0.06% is 16.67 million. So that's an over $8.3 million value wiped out. And remember, the building didn't lose a single dollar in net income. It was making $1 million then, it's making $1 million now. And this is literally what's happening right now. So in many markets, cap rates have expanded by 150 to 250 basis points, which is 1.5 to 2.5%. And that swing alone has erased millions of dollars in property value, even if occupancy and income stayed the same. So it's a different crisis today, but the same kind of opportunity. If you're prepared, if you know how to raise capital, if you've packaged your credibility properly, then you're going to see the most attractive deals in the last 15 years flood your inbox. So, what does packaging your credibility actually look like in practice? Well, part one, Packaging your credibility makes it obvious and easy for someone to trust you with their capital, not with hype and not with big promises, but with clear positioning. Here's what it sounds like in practice. I'm a contractor who's built over 100 homes. Now I partner with investors to buy small multifamily in North Carolina because I understand the construction costs and timelines better than most. See, that's packaged who you are, what you've done, why it gives you an edge, and what you're focused on now. No need for fluff, just facts with context. Compare that to, I'm just getting into real estate and looking for capital. Look, that's not packaged. That's just noise. No one is going to take you seriously. And the funny thing is, even if you have less experience, you can still package your credibility around the domain expertise, backstory, or your proximity to a deal or a team or whoever it is. Now, the question you might be asking is, well, how can someone start building investor trust if they've never done a deal before? So here's how to do it if you're brand new. Number one, pick a focus. I'm learning how to invest in multifamily in the Midwest. That's specific. Part two, document your journey. So post weekly insights, what you're learning, markets you're paying attention to, how those deals are structured. Part three, connect with the experts, interview smarter people than you, and share those conversations. Part four, be honest, but be intentional. So saying, I'm not raising yet, but I'm building the foundation for a long term business. You don't have to be a surgeon yet, but look, you can be the med student who knows their stuff, asks great questions, and clearly cares about mastering the craft. So, what do I do now? Just sit on my hands and wait? I mean, you're telling me that the market's crashing. I mean, well, look, let me bring this all together for you. I mean, for context, we bought a 144 unit building in 2013 when all that pain with high interest rates really started. And for a little more context, they wanted 16 million. We paid 11.1. Now, less than 2 years later, it literally recently appraised for just nearly $18 million. Why? Well, because when they needed to sell, we were ready to buy and we had the capital ready before we actually needed it. So let me break down what made this deal so profitable and how that actually segues into what's going on today. Now, for context, this deal was literally a textbook example of a distressed opportunity, not because the asset was bad, but because the previous operator got caught in a debt cycle. So here's what happened. Number one, the bridge debt he had on the property blew him up. So, in other words, he had a floating rate financing arrangement that more than doubled his interest payments when the rates shot up. So, even when the property was breaking even or making a little bit of money at maybe a 3% interest rate, when his rate went over 8%, or I think it was close to 9%, all the cash flow got wiped out. And I don't think he could refinance in a way that made sense. Number two, the rents on the property were 20 to 30% below market. So because he was dealing with such high interest costs, I don't think they had the money in place to do the renovations required to get the rents. So literally, same units, same locations, but he just wasn't able to keep up. And because of that, he got below market rents. Now, that insight gave me instant confidence to acquire this asset because I knew that by modernizing the finishes and repositioning it in a stronger market with tenants that were looking for that kind of inventory would find me people and increase the rents by 20 to 30%. And that's exactly what happened. Number three, I was super confident in this deal because the renovations were all cosmetic, nothing structural, no major plumbing issues, no roof issues, no, you know, digging up driveways to find broken pipes. It was paint, fixtures, and some LVP flooring. And what that was, it was easy to execute and be really hard to screw up. And number four, what I really like this deal is the location was fantastic. A growing population, good employment, drivers, people wanted to live there, not much competition. Actually, since taking over the property, we've been able to maintain 96% plus occupied because people want to live there, and that's literally half the battle. Now, look, you're not going to find these types of deals on LoopNet. You find them through relationships and readiness. So here's what I tell people talk to brokers literally every week. Let them know you're actually capable of closing, not just shopping around. Look for properties with bridge loans maturing soon. That's literally where the stress is hiding. When you're talking to brokers, Ask them, do you know any owners that might need to refinance but can't qualify at today's rates or having some issues? Then drive the neighborhood, look around. If a property looks like a C plus, but rents are D and the neighborhood looks like it could be a B plus neighborhood, then dig in. And look, the most important thing here is don't chase perfection, chase pain. You need to find operators who are tired, over leveraged, or just want out. That's where the upside lives. So, what should you do to take advantage of everything in this video? Well, part one is you need to have a practical way to start building trust today, even if you don't have a deal yet. So, part one of that is frame your story like a pro. Look, money doesn't just chase spreadsheets, it chases certainty. And part two is stay close to operators doing big things. A lot of mid tier players are about to get wiped out. So, if you're trying to figure out where you fit, figure out what the big boys are doing. And to get into the communities with these big boys, there's two ways to do it. Number one is earn your way in, and part two is pay your way in. Ideally, do both. Option one, earning your way in, well, show up with value, share their content, ask better questions, and offer help without expecting anything in return. Now, look, full disclosure, this path does take longer, but it does build deep trust over time. Option two is what I call pay for speed. Now, look, if you want to collapse your timeframes, pay for access. Go to workshops, join masterminds, hire them, pay for the service. Look, when you put money down on something, you're not just buying information, you're buying proximity. And with the more solid groups out there, you're actually buying implementation. I can tell you that I've met some of my best long term partners, people that I still stay in touch with to today after engaging them in some kind of a paid service. Why? Well, because the people in those types of rooms are typically the most serious and committed. Think about it, they're literally playing the same game. And the cost of admission has already filtered out a ton of the tire kickers for you. So, yes, network, add value, build relationships, but also write the check when you can make it make sense. It'll help you avoid years of trial and error. And trust me on this, it's worth it because the last time this types of collapse happened in the financial sector, it minted a whole new generation of millionaires. And this time, in my opinion, those who have the capital ready to go are going to build serious generational wealth. So, guys, if this video hits home, obviously hit the subscribe button. I post content like this for capital raisers, deal makers, founders, people that are building leverage in their business and are tired of playing small. So, thanks for the watch, and I'll see you on the next one.